Hello and welcome back to the Trade Management module, Trading Psychology. In the final section, we'll examine the role psychology plays in the ultimate success or failure of a trader, and give you tips on how to avoid common pitfalls that plague most aspiring traders. In this lesson, you'll learn the emotions that you can expect to encounter when trading. You'll learn how to manage the individual risk of each trade. You'll learn the importance of good reward to risk ratios. And finally, you'll learn what behaviours to avoid when placing trades. Let's first talk about managing emotions. As important as all the information that you have learned so far is, it will not amount to much if you fail to integrate the correct psychology into your trading plans. Many traders believe that a good trading strategy is all that is required to make money from the markets, but if you don't incorporate the correct mindset, your trading journey may not end up at the destination you are hoping for. If a definition was applied to trading psychology, it would read something like, a trader's ability to allow human emotions to dictate the success or failure of their trades. In fact, there are 4 important characteristics that traders must possess to be successful. Firstly, emotions. A trader must be able to control their emotions while executing their trade plans. The second one is discipline. A trader must maintain complete discipline throughout the trading process. The third one is perspective. A trader must maintain a clear perspective when placing trades. And the final one is adaptive. Traders must be able to adapt to the changing markets and adjust their market vision accordingly. It is said across the investment industry that 90 to 95% of people attempting to become professional traders fail, and only the remaining 5 to 10% are actually successful. Now at first this may seem very disheartening to think that you could have over 90% chance of failure, and common sense would probably lead you to run as fast as you can away from trading, but you must put these numbers into perspective. It is widely acknowledged that the majority of the 90% of aspiring traders who do fail are not educated in the discipline to begin with. However, by learning trading fundamentals, you are placing yourself ahead of the game in terms of education, and will increase your chances of reaching your investment goals. So far, this course has focused on arming you with the tools you need to trade successfully. Having learned these rules, the last thing that can really impact your success as a trader will be your trading psychology. Let's now talk about managing risk. One of the most important components of trading psychology is your ability to manage risk. Many traders believe that risking a certain percentage of their account per trade is managing risk, and for the most part, it is. The problems that most beginners face is that the risk management component starts out with good intentions, only to fail them when they need it most. There is no right or wrong trade size when it comes to placing trades, as each individual account will have varying balances. A great risk management approach is to risk only a portion of your account per trade, say 1%. This means closing positions that lose more than 1% of your whole starting account balance. Now in theory this would work fine if the trades that you have placed are appropriately diversified. As an example, if you have a portfolio valued at $100,000, you would risk $1,000 per trade. Now if the risk is spread across 10 different positions, the most that you would stand to lose if all of those positions turned against you is $10,000. The example you can see on the screen shows a trader with a $120,000 stock portfolio risking only 1% per trade, with a bias to rising bank shares. They have taken long positions on CBA, ANZ, NAB, WBC, BEN, and BOQ, with an allocation of $20,000 per position, and stop losses set on each of these positions at $1,200. Now, although this trade has only risked 1% per trade, if their bias on rising bank shares in Australia is wrong, all of these trades are likely to fail because there is no diversification into other sectors, such as resources and consumer staples. This could mean that this trader could lose 6% of their portfolio value in an otherwise rising market with a weak financial sector. Now, the thought of having your account down 6% should not be too daunting, but this type of trading pattern could lead to consistent losses down the track if you keep selecting the wrong sectors at the wrong time without adequate diversification. Another misconception that traders have is that if they lose 50% of their trading account, they only have to make 50% back in order to be square again. The example that we can now see on the screen shows how much percent you actually have to make back to get to a break-even position after a drawdown. As you can see, if an account gets down to 50% of its initial balance, you'll have to make a 100% return on the remaining balance to bring it back to where you started. If a trader was risking only 1% per trade, and now only has half of their initial starting balance, then a number of things may have gone wrong. They may have risked the wrong amount on the trade and taken a significant hit to their account. They may have risked the right amount and exercised poor diversification techniques as we discussed earlier, or they could just simply have a very poor trading strategy. Now, if 95% of people fail at becoming successful traders, you could imagine that even more would fail to resurrect an account that lost half of its value. After sustaining such a loss, it is unlikely that even correct risk management could bring the account to a profitable position. And the reason for this is simple. Even considering that there could be something fundamentally wrong with their trading methods, the odds are stacked so far against this trader, so much that they would be overwhelmed with the prospect of what's required to just get back to their starting position. Some of the biggest fund managers in the world, who have teams of analysts, experts, and every conceivable resource aimed to outperform a major index as a benchmark. Now on average, most indices will achieve around 5 to 7% per annum return when averaged out over rolling periods of 10 years or greater. For this example, let's say that a good fund manager will outperform the index by a net 3% per annum every year, and let's also assume that the index will have an optimal year every year. Although both scenarios are highly unlikely, let's assume that the fund manager consistently nets a 10% annual return. Even in this optimistic example, if you factor in compounding account balances, where no withdrawals are made, it will take this fund manager more than 7 years to make a 100% return. Going back to our previous example, the trader who lost half of their account's value will have to consistently perform as well as this fund manager for more than 7 years just to get the account balance back to where it started. What inevitably happens is that the same trader will attempt to take extra risk to get themselves out of their predicament by increasing their trading size. It is most likely that the trader will then proceed to take the account to zero, or, what sometimes is a worse scenario, get lucky and quickly recoup their losses. Now at first, that sounds like a good situation to be in, but in reality, this trader has taken what would be extraordinary risk to get themselves out of the hole, and will probably feel that they have beaten the market. This may lead to the trader making larger trades with even greater risk. However, at some point, the market will show them that their previous risky processes with a fortunate outcome is not a sustainable practice. If you do find yourself realizing that you have made a mistake with a trade size and incurred a larger loss than expected, it may be better to replenish your account with the amount lost if you can afford to, and start the balance where it was before the error. Let's now look at reward to risk ratios. In terms of trading, reward to risk ratios can be described as how many units of reward there is for each unit of risk. For example, if you apply a risk of 1% per trade and the take profit is set to 4%, then you would have a reward to risk ratio of 4 to 1, 4 parts reward for 1 part risk. Now reward to risk ratios are generally set around 1 to 1, 2 to 1, 3 to 1, 4 to 1, and 5 to 1. These ratios can sometimes be bigger depending on the pattern, which is great, but they should never be smaller. You should never enter a trade that has a reward smaller than the initial risk, as the win ratios to make these types of strategies successful are very difficult to maintain. The only exception is if you are trading using options, where some strategies demand this style of ratio, but they are generally fixed risk with highly likely profitable outcomes. Strategies with higher ratios, such as flag patterns and moving average crossovers, can be profitable with lower win ratios. For example, a flag pattern generally has a 4 to 1 reward to risk ratio because of the way the stop losses are placed compared to the projected take profit. Now as you can see in the example on the screen, on a low reward to risk strategy, you need to have more winning trades than losing trades to make a profit in the long run. When using strategies that don't require high win rates, like flag patterns and moving average crossovers, you can actually have more losing trades than winning ones, and make the same profit or more over time. Now let's look at maintaining discipline and behaviors to avoid. Some of the most successful people in the world are investors and traders, but they didn't just get there because they were lucky, as luck can only hold you up for a certain amount of time. The most successful traders have amazing discipline to execute their trade plan and make smart decisions. Remember that not every trade you place is going to work out, but what will make you successful is how you handle the losses and downtimes, because the good times will take care of themselves. The key is to ensure that you maintain the discipline to follow through with your trading plan. Although allowing emotional involvement can have a positive impact in many aspects of life, trading is not one of them. In fact, the key to becoming a successful trader is to try and keep emotion completely out of any part of your trading decisions. Some of the biggest issues that traders have when it comes to trading psychology generally play out in the same fashion, and can be attributed to a handful of undesirable behaviors. The first one is greed. Greed is an emotion that many traders don't believe they are affected by. These traders will set unrealistic goals because they try to take out of the market what they want, rather than what is achievable. More often than not, this type of attitude leads to traders not taking profits at the correct areas because they haven't made enough money or want that little bit more out of their trade. This is yet another example of why you need to leave your emotions at the door when you are preparing to trade, as any interference to a sound trade plan is simply sabotaging your chances of becoming a successful trader. The next emotion to avoid is fear. Fear is an emotion that creeps up on traders without them knowing it is there until it's too late. It generally comes in the form of not wanting to take a loss on a trade because they are afraid of losing money. You may have heard of the saying that you must spend money to make it. In a sense, trading is no different. As I mentioned earlier, you will not make money on every trade that you place, so you must be able to deal with the fact that some trades will simply not work out. Another symptom you want to avoid is the never wrong syndrome. Many traders fall into the trap of refusing to take a loss, and rather than using a stop loss to mitigate risk, they let their losses run in the hope that the market will turn around. This being the case, if you find yourself wishing and hoping at any stage of a trade, you should consider closing your position immediately. When you combine the right psychological mindset with the other risk management tools that you have learned in this module, you'll see how these pieces fit together to provide you with the blueprint for trading success. Remember that this course has given you all of the tools that you need to be in the top 5% and become a successful trader, but how you use them and the effort you put in will ultimately determine your success. There are no get-rich-quick schemes in professional trading, and only hard work and commitment will get you where you want to be. This concludes the trade management module of the Ultimate Masterclass. We hope that what you have learned is useful to you in your investment journey and can take away the many powerful and effective techniques to help you become a more profitable trader and investor.